Hi everyone, a very good afternoon to all of you present here. I'm Natisha Jain, Assistant Manager of TaxBuddy. This is income tax. Today, again, after a long time, we are connecting, and in this session, we'll be discussing about the best investment plans along with tax saving options. So, as you all know, that financial year have already begun. So, financial year has already begun, and now it's high time to think about your investments, to know that where you can invest, how you can invest, and in what all the investment plans you can bifurcate your money and get the long term returns or short term returns as per your requirement. Along with that, you can manage your taxes. You can save your tax liabilities. You can reduce the tax liability to a great extent after claiming all the deduction parts and everything. So, normally it is said that don't waste the time and think about all the investment schemes and where you have to just invest your money from beginning of the financial itself. So if you will start investing from now onwards, then you'll be able to claim monthly returns, and it will increase your income as well as it will reduce the tax liabilities also. So without any further delay, we'll move towards our today's agenda. We are going to discuss first of all the introduction part. So in the introduction part, we'll be seeing that why is it important. So then we'll be seeing what are the how you can plan your tax saving investments, what are the tax saving instruments, and this will be followed up by Q&A session. Moving forward to the introduction part, as it is said that the tax saving is a very important instrument, or tax saving is a very important thing for every individual who is earning income, who is paying taxes. So, how to save tax, or rather, how to plan your investment, is a question that bothers each one of us, right? So, while planning taxes is crucial, tax saving schemes are also essential. You can save tax and earn returns with the best tax saving schemes in India. Ideal time to plan for tax saving investment is the beginning of the financial year. This will ensure you don't pay more taxes and save taxes in India with with the long term year returns on tax saving investments. While we all aim to save taxes in India, why only few of us succeed? Have you ever thought about that? Answer could be because of lack of knowledge or struggles in fitting the best suited choice in your investment planning. There is one famous saying which goes like, a penny saved is a penny earned, which means tax planning is one of the ways which can help you to save on taxes and increase your income. Income Tax Act provides deduction for various investments, savings, and expenditures incurred by a taxpayer in a particular financial year. Now we will discuss some of the avenues right over here. Before going forward, I would like you to say that if you have any questions during the session, you can just post down in the chat box. I'll be answering each and every question of yours during the session also, and even after the session. If you have any doubt, you can write to us at support@taxbury.com. This is our support mail ID. So yes, then going towards the how to plan your tax saving investment. As it is wrote, April 1st is the beginning of tax saving season. You can invest into from tax saving starting from 1st of April. It's already 13th April today. So you can start still. You have plenty of time. You can think about where you want to invest and you can just start taking steps. ATC is one of the most common and favorite section of every taxpayer, I can say. Amongst that, now the tax saving instrument and sections are, first one is fixed deposit. So fixed deposit are considered one of the safest tax saving schemes. It is safer than equity investment in terms of risk and returns. If you have invested into FD, if it is a normal FD, then you are not going to get the deduction. But if it is a tax saving FD, then you are going to get tax returns. Then you are going to get a deduction under 80C of the Income Tax Act. So, banks decide the interest rates and it depends on several factors. Like investment in tax saver FD is eligible for deduction under ATC while calculating the taxable income. Second, tax saving FD investment has a minimum lock-in period of 5 years. You have to invest till 5 years, and after that only you can withdraw the amount, or you can use that FD amount for some particular purpose, whatever at that time is suitable for you. Then, senior citizen can get a higher rate of interest on this investment. In case of joint account, primary holder can avail the benefit of tax deduction while calculating the taxable income. Tax saver FD do not allow any premature withdrawal. But after the expiry of 5-year login period, investor get access to premature withdrawal, and the terms and conditions vary from bank to bank. Of this premature withdrawal, it will vary from bank to bank. They may ask you that why you want to just premature, why you want to withdraw it before the time, before 5 years lock-in period. So according to that, it will depend totally on banks to bank. But yes, it is a risk-free investment. You can invest into this, and you have to just invest till the period of 5 years. After that, if you want to continue, you can. If you want to withdraw your amount, that also you can. Next come is Public Provident Fund (PPF). PPF has always been a very popular tax saving schemes among most of the taxpayers. One of the major reasons of this popularity is that PPF falls under the category of exempt, and exempt tax status. You can open your PPF account with bank or post office, and then you can claim deduction under 80C of the Income Tax Act for the amount which is invested by them during the financial year. Maximum amount eligible for deduction would be again 1.5 lakh rupees, because PPF also falls under ATC category. The PPF falls under exempt category, which means interest and maturity amount. Both these things are exempt from tax. PPF account have PPF if you want, if you are thinking to invest into PPF, then make sure that you are thinking for long term purpose, because PPF has a highest lock-in period of 15 years, and it allows the investor the options at the end of the maturity period. First one is withdrawal of proceeds from the account, and second one is continue for another 5 years. So if you want that you have to invest your money and forget about it, then surely you can go for PPF. Now comes the another investment, which is ULIP, Unit Linked Insurance Plan. ULIP again is a long-term investment product which will allow you to choose equity funds, debt funds, or both. If you are flexible to switch between the funds, then you can go with ULIP plan. And by investing into ULIP, you will be getting deduction under two sections: ADC, which has limit of 1.5 lakh rupees, and another one is section 1010D of the Income Tax Act. In both these sections, you can claim the deduction of ULIP plan, Unit Linked Insurance Plan. Another deduction, another investment which you can invest into is National Savings Certificate (NSC). It is a government of India's initiative. National Savings Certificate again, it is a fixed income investment scheme that aims at the small and medium income investors to invest and earn the handsome returns. It is considered a low risk investment and as secure as provident fund. You can invest into this as per your income profile, your investment habits, and everything. So, investment into NSC, it will qualify deduction under ADC of the Income Tax Act up to the limit of 1.5 lakh. Apart from providing the benefit of tax exemption, it also provides the investor with complete capital protection and guaranteed interest. Some of the features of NSC are like, first of all, 8% of annual interest rate as a guaranteed return, as it is a fixed return investment. So, if you are investing into NSC, you are sure going to get fixed percentage of interest amount, fixed percentage of interest rate. Then second benefit would be you can claim deduction under ATC. Then third benefit, you can invest as low as rupees 1000. You can also increase investment amount as per your convenience, but uh, amount you can invest, so you can start investing from 1000 rupees or multiples of 100. On maturity, entire maturity amount will be received by the investor and the same will be taxed in the hands of taxpayer. Early exit in this is not available. You can use the same as collateral security in case of loans from bank or NBFCs. But early exit is not available in this case. Now, coming on to the next investment. If I talk about the next financial instrument in which you can invest, is the senior citizen savings scheme. Those whose age is above 60 years, it is for them. Under this scheme is available for investment. It is through banks or post office, and it offers one of the highest rates among the various savings schemes. Depositors can make an investment with minimum amount of rupees 1000 and in multiples thereof. This scheme also provides the facility of investment through cash, provided the investment amount is less than rupees 1 lakh. Deposits made into this scheme, it will mature after a period of 5 years, and you will also get an option to further extend the maturity period by another 3 years. It is also an eligible deduction under ADC of 1.5 lakh limit, and the interest on such deposit is fully taxable and liable for tax deduction if the interest amount is above 50,000 rupees. As you would be knowing that senior citizen, if you are a senior citizen and you are receiving any amount of interest, then whatever interest amount you are receiving, that interest amount is eligible for deduction under section 80 ttb. Under 80 ttb it is available up to the limit of 50,000 rupees. Next comes is NPS. Now, if you think that you have done all the investment of ATC and you have exhausted the limit under ATC, you want to invest more, you want to go for long term planning, then NPS is the best source. NPS is National Pension Scheme. National Pension Scheme says that it has become a popular income tax saving investment product. It is a tax saving option that is available to both government and private employees. It enables the depositors to build a corpus for their retirement along with the regular monthly income. Amount invested by the depositor is invested in several schemes, including the equity market. Now, there are two types of NPS accounts, Tier 1 and Tier 2 account. Tier 1 account has a lock in period until 60. Contribution made by the subscriber to Tier 1 are tax deductible under 80 CCD1 and 80 CCD1B. Now, there is one more thing which I would like to add in this. 80C plus 80 CCD1. 80C we have already covered, and 80 CCD1 talks about NPS. These two sections has a combined deduction limit of 1.5 lakh. But if you are investing into 80 CCD1B, which is also an NPS section, but 80 CCD1B provides an additional deduction of 50,000 rupees, up to 50,000 rupees. So if you are investing into NPS, then go for 80 CCD1B section if you have exhausted the limit of 1.5 lakh from ABC and you want to claim more deduction, then additionally 50,000 you can claim from NPS, and altogether from these two sections, from ATC plus ATCCD1B, you can claim 2 lakh rupees of deduction, and your total taxable income will reduce from 2 lakh rupees. After suppose earlier you were having income of 12 lakh, then you claim these two deduction. From ADC you claim 1.5 lakh, from ADCCD1B you claim 50,000 rupees. Then 2 lakh total deduction you claimed, and now your total taxable income would be 10 lakh rupees. Earlier you were into 30% slab rate. Now you are falling into 20% slab rate because your income now it is up to 10 lakh rupees. In the old tax regime I'm talking about, new taxation regime have another clause, another tax rates, and everything is different in that new taxation regime. So this is the benefit of claiming deduction under NPS. Your deduction amount will get increased. You are going to get long term returns. So, as per this provision, individual can claim deduction up to 1.5 lakh in ADCCD1 made by the taxpayer towards the NPS. This was all about the ADC sections. There is one more section, one more component, subcomponent of ADC, which is ELSS mutual fund. If you are investing into ELSS mutual fund, equity linked savings scheme, this is also a tax saving instrument under ADC, and you are going to get deduction up to 1.5 lakh rupees. It has a lock-in period of 3 years. ELSS has shortest lock-in period. If you want to invest for a short-term period and earn high returns, then you can go for ELSS. It is a good instrument or good investment scheme. Now, these were all about the ATC sections. Now coming on to the different part, which is ATD section. Under ATD, it talks about the medical health insurance premium or medical health insurance expenditure. If you are a non senior citizen, your age is below 60 years, you have taken a health insurance policy. You are paying premium for that. You are paying premium for yourself, your spouse, or your children. Then you are eligible to claim total deduction up to 25,000 rupees under ATD section. And along with this, you can also claim 5,000 rupees as a preventive health checkup. Now, if you are a senior citizen, you have taken health insurance policy for yourself and your spouse. You can claim total deduction up to 50,000 rupees if your age is above 60 years. If your age is below 60 years, then 25,000 you are eligible to claim. But if your age is above 60 years, then you are eligible to claim 50,000 of deduction. One more thing about this section. Suppose you have taken health insurance, you are incurring medical expenditures of your senior citizen parents who do not have health insurance policy in their name. But you, as a non-senior citizen, you are incurring, your age is below 60 years, you are incurring health insurance expenditures, medical health expenditures of your senior citizen parents, and you are paying their bills. Then also you are eligible to claim deduction up to 50,000 of rupees. This was all about the ATD section, medical health insurance. Now ATEB, if I talk about, nowadays electric vehicles are very much into trend, right? So for that purpose, government has provided interest loan. If you are taking loan to purchase the electric vehicle, then interest paid towards that electric vehicle, you can claim deduction under ATEB section up to 1.5 lakh rupees. ATG talks about the donations. So, if you are donating any amount to any charitable organization, to any NGOs, then you are eligible to claim deduction up to 50% or 100%. It varies. So, 100% you are eligible to claim if it is if you are donating to any National Defense Fund, if it is a donation to any PM relief fund, likewise that. If it is a government charitable organization, then you will be eligible for 100% deduction. Otherwise, every donation amount is eligible for deduction up to 50%. Suppose you have donated 4,000 of rupees to one charitable organization, which was registered. So that registered charitable organization you donated, you got that receipt and everything. But in your ITR, you will be eligible to claim only 2000 rupees, as 50% deduction amount is only eligible. One more thing, that if you are donating any amount in cash above rupees 2000, then you are not eligible to claim tax deduction under 80G section. Only cash amount which is up to 2000 rupees is eligible for deduction. If you want to donate more than 2000 rupees, then make sure you are donating in any online form, either online payment mode or from your card or from your net banking, anything apart from cash. If you want to donate more than 2000 rupees, then for claiming deduction, you have to donate it apart from cash. Okay. Then next, tax deduction under 80 TTA section. This section says that if you are having if you are having any saving bank interest amount, then you are not a senior citizen. You are incurring in your bank, you got saving bank interest amount. That amount, if it is up to 10,000 rupees, it will be exempt. But if it is more than 10,000 rupees, then that above amount, exceeding amount 10,000, that will be an taxable income. If you are suffering, if you yourself are suffering from any kind of physical disability, then section 80U will come into picture, and under this you can claim flat deduction of 75,000 rupees. But if it is a severe disability, first of all you have to get a medical practitioner certificate that you are incurring from physical disability. If it is a severe disability, which means disability percentage is 80% or more, then you are eligible to claim 1,25,000 of deduction under 80U. So this was all about the deduction part. Now I'm going to highlight some of the budget changes which are going to impact every individual in terms of taxation. So insurance policy was one of the change. Under this, if you are taking any if you are incurring any life insurance policy, you are paying annual premium. If that annual premium till 1st of April 2022, nothing was changed. But from now onwards, from 1st of April 2023, if your premium amount exceeds 5 lakh rupees, then it will be taxable. Earlier, there was no such limit. Up to now, up to 5 lakh rupees, it will be exempt. But if your annual premium amount is exceeding 5 lakh rupees, then it is taxable. This was about the insurance policy premium post budget. Next change which came was of new taxation regime. New taxation regime got many changes. Amongst that, first one is that rebate amount got increased from 5 lakh to 7 lakh rupees. Then exemption limit, earlier which was 2.5 lakh rupees, now it has been extended to 3 lakh rupees. These are the changes I'm saying are only applicable for new tax regime. Okay, not for old taxation regime. Old regime have no changes. Standard deduction is also now available for the new taxation regime people, salaried people who are opting for new taxation regime. Earlier, they were not eligible for standard deduction of 50,000 rupees, but now from 1st of April 2023, this financial year, that which means that the next year return which you are going to file, in that you can claim standard deduction. You can claim the rebate amount up to 7 lakh rupees, exemption amount up to 3 lakh rupees. These all changes are applicable for next year's ITR filing, but financial year will be 23-24. At present, we'll be filing ITRs for the financial year 22-23. So in 22-23 financial year, there were no changes in new taxation regime. These are all the changes which will be applicable from next year ITR. These are applicable for this financial year, but as you know that we always file the ITR of the financial year in next year. So financial year 23-24 ITR will be filed in next year, 2024. So these changes will be applicable for that time. Now, slab rates were also changed. 0 to 3 lakh, there is no taxation in new tax regime. It is exempt. From 3 to 6 lakh, tax rate is 5%. From 6 to 9 lakh, it is 10%. 9 to 12, 15%. From 12 to 15, it is 20%. And above 15 lakh, it is 30%. In old taxation regime, if your income is exceeding 10 lakh rupees, then you have to pay 30%. But in new taxation regime, if your income is exceeding 15 lakh rupees, then you have to pay 30% slab rate. Also, new taxation regime has been made the default tax regime. What do you mean by now default tax regime? This means old and new taxation regime both are applicable as of now. But if you are filing your ITR after the due date, which means 31st July 2023 is the due date for filing ITR, right? If you are filing your ITR after 31st July 2023, then by default you will have to pay taxes under new tax regime only. There is no option to pay tax under old taxation regime. Surcharge rates have made changed earlier in old regime surcharge was for more than 5 CR rupees. It was 37%. In new tax regime for more than 5 CR, you have to pay 25% surcharge rate. TDS limit pre-budget for the EPF withdrawal, it was 30%, and cash withdrawal limit was 1 crore rupees. Now the limit has been reduced to 20% post-budget, and the cash withdrawal amount has been increased to 3 crore rupees. This was all about our today's session, where you have to invest, how you can make the investment, what are all the deduction limits which you are going to avail. These are all the things which we discussed in our session. If you want to take any help, if you want to take help in filing your ITR, if you want to take help in any notice cases if you have received for ITR U filing, or for any tax planning services, anything regarding taxation, then you can just visit to taxpari.com website. There, all the CAs are there to help you out, and everything will be sorted very soon. So I hope you enjoyed this session. It was useful one for all of you guys. Now, if you have any question, then you can just post down in the chat box. We'll wait for 5 minutes, and then we'll be ending up this session. If you have any questions, you can write in the chat. I think there are no questions. We can wind up. If you have any queries, you can write to us at support@taxpuri.com, and we'll see